Okay, I think we'll start now if that's okay. Before we begin, a couple of short housekeeping points. Please do put some questions in the Q&A box, which I think is at the bottom of your screen. We'll either have time to answer those at the end via my colleague in our London office, Harriet Strevens, who will manage that, or we'll aim to come back to you separately offline. In the event of a fire, please do just press leave meeting. So good morning, everyone. Today's 15-minute session is a continuing session around policy coverage in the theme that we've been covering for the last few months. A brief introduction, Daniela is a senior associate in our Manchester office, and she's been with Mills Reeve since 2016, and during that time has mainly defended claims against law firms. I've been with Mills Reeve since 1993, and if I could hear you, I know you'll be crying, but you look so young. And I've also spent most of my time defending law firms and managing coverage disputes. The session today is aimed at providing a snapshot of the minimum terms and conditions. And just for completeness, the wider framework for the minimum terms and conditions includes the SRA indemnity insurance rules and the participating insurers agreement. We'll also touch upon the changes we may see in the next few years. So the last 20 years, why is that slide up there? Well, in year 2000, that was when the MTC were born, and also it is when the primary layer insurance program went to the open market. Prior to that, there used to be a mutual policy, and the change from the mutual to the open market largely arose because the mutual had suffered continually large losses, and there was a huge amount of pressure from the larger law firms for this to happen. In short, the larger law firms felt that their premiums were funding the wider profession, and in particular funding the rogue element of the wider profession. The recession in the mid-1990s had also resulted in unprecedented losses to the profession, most notably arising from conveyancing transactions. Who knew? So if we look at the changes that have happened in the last 20 years, if we go back to 2000, some of you may remember Y2K, which was the bug that was concerning us at that time. It's called the Millennium Bug, but as it happened, it didn't end the world. There was the Millennium Dome was opened for the first time, only for a bit, and became the O2. We also had the Nokia 3310, which was released, and for those that ever had it, you'll remember with fond memories the game Snake. However, relevant to this talk is at that time, law firms were basically happy partnerships. If we jump forward to the year 2020, the UK is out of Europe, England still haven't won a major football tournament, and yesterday the iPhone was released. And for anyone who has got a teenage son or daughter at university, I'd strongly recommend that you purchase it, because one of its attributes is that the glass screen has been enforced with nano ceramic crystals, which means it's 4 times less likely to smash when dropped. What I would add to that, certainly in my daughter's case, when dropped, when drunk. When we look at law firms, they are now partnerships, limited liability companies, limited companies, ABSs and PLCs. Now, before we go on to, sorry, Daniel, if you just go out to the previous slide, before we go on to the next slide, just something to, a bit of synergy between 2000 and 2020 is David Icke. Some of you may know him, and certainly I knew him when he was involved in the football world. But he's got a conspiracy theory about the current pandemic that we're facing at the moment, which is effectively, it's all to do with 5G. Just true to form, he also had a conspiracy theory about Y2K, where he said that Y2K, and I can quote it, will give governments around the world the excuse to collapse the computer systems. So it's always good to know that David Icke is in our corner. Next slide, if you can, Daniela. Thank you. So what I was trying to indicate there was that the legal profession has gone through significant transition over the last 20 years, more so actually over the last decade, and very quickly. Essentially, they've become more businesslike. However, the solicitor's indemnity insurance policy has largely remained unchanged. The MTC is mandatory. It's also gold-plated in nature. It does, on the positive side, provide a level playing field for all insurers, by which I mean everyone knows what you're insuring and that your competitors are also insuring on the same basis. However, it does create a significant lottery in terms of runoff in particular, and that's what we're going to touch upon a little bit later. There have been a few changes over the last year, but not a lot, over the last 20 years, but not a lot, and certainly nothing of any real commercial substance. A couple to mention would be that the one claim aggregation clause was tinkered around with, I think, around 2007. The minimum level of cover moved from 1 million per claim to 2 million per claim, or if you're an incorporated entity, it goes to 3 million per claim. And also the reimbursement and disclosure clauses were changed and adapted in response to the Insurance Act 2015. There have been some attempts to adapt and amend the change. So if we look to the next slide, Daniela, if possible. There were various consultations between 2014 and 2019, which did give some hope to insurers that there may be some significant changes on the horizon. That was 6 years ago when that kicked off, and again, nothing has happened. In terms of just a bit of context to that, for the 10-year period up until 2014, it was estimated that the claims and damages paid out by the insurers for the profession came to about £2.2 billion. So that was one of the drivers for change at that time. In terms of the 2014 consultation, it's just interesting to note, and I'll come back to this a bit later, that only one of the top 50 firms actually responded to that consultation. So that shows the level of interest from the larger law firms at that time in any change. The hope was at that point that there may be a reduced limit of indemnity down to £500,000 per claim. There was also hope there might be an option to aggregate the total level of cover to be insured, and also that the runoff period might be reduced to 3 years. So what was the outcome of those consultations? To be frank, not a lot. There's been no change of any significance as a result of those. There were 2 consultations during that period, which is not good news for insurers, and I'm sure that that went down pretty badly given the time and effort that was put into that process. The question I would ask is whether it's actually good news for the law, for the profession itself, not to have any change to the policy. In short, I don't think it is good for the status quo to continue. It's something I'm going to come back to later. So I'll now pass over to Daniela.
Thank you, Angus. So I'm going to cover very briefly what a solicitor's policy actually does cover. So the first point to look at is the insuring clause under the policy. I've set out the whole clause there on your screen if you'd like to read it. I won't read it all out, but I have highlighted the key points. And they are that it covers a civil liability arising from a private legal practice in respect to the claim, which is either first made against the insured or arising from circumstances first notified by the insured. Important to note that claims also include legal ombudsman's awards and other policies. A solicitor's indemnity policy covers for defence costs which are in addition to the indemnity limit. So to look at that first limit of the definition there, which was claims, a solicitor's policy is a claims made policy. So that is also defined in the policy, which I've set out there for you. Again, I won't read that out, but I have highlighted the relevant points, which are that it is a demand for civil compensation or an imitation of an intention to seek that compensation from the insured. The obligation to remedy a client account shortfall under the solicitor's accounts rules is also deemed a claim under the policy, so it's worth keeping that in mind. I've just put a note there about notification. Notification is a requirement under the policy by an insured. However, cover is still triggered even if there is a valid claim which the insured has failed to notify or report to insurers. So again, always worth keeping that one in mind. If we move on to the second limb, which was the circumstance notified by an insured. Again, I've put the definition up there on the screen for you. But the main point here is that it is an incident which may give rise to a claim. So there has to be a link to the circumstance notified and the claim made later down the line, as it may fall back to the insurers who were notified of that circumstance if it was a prior year. The definition of insured is also provided for in the policy. And briefly, it includes employees, former employees, principals and former principals of the insured, and it also includes prior and successor practices. I'm just going to leave that point there because prior and successor practices in itself is a topic for a whole other seminar. So we'll leave it. Angus also touched upon the fact there's a 6-year run-off period under solicitors' indemnity policies, and that means where a law firm has ceased practicing and has closed down during a period of insurance, the insurers have an obligation to provide a 6-year run-off period. So move on now to things which are not covered, the exclusions in the policy. I'm just going to touch upon a few. There are quite a lot in the policy, and I refer you to that if you want to look at them in more detail. But the main ones I'm going to cover today are dishonesty. So a dishonest act committed by all, or condoned, sorry, by all members or partners of the law firm is not covered. I've put there the innocent are because if it's found that one partner or member is innocent of that dishonesty, then cover is provided, although the dishonest individual will face recovery action by insurers and the disciplinary action from the regulator. So it's just worth bearing in mind that cover is provided, but the dishonest individual will likely be penalised. Trading debts are not covered under the policy. So examples there are where the insured law firm is suing for any unpaid bills or are being sued for any of their own unpaid bills, and those are not covered under the policy. If there was no underlying legal transaction in respect of the claim made, so for example, an example is where a solicitor may have simply allowed funds to have passed through their client account, so they were acting like a bank. That doesn't arise from any private legal practice as part of the definition that I read out earlier, so that would not be covered. I've also mentioned here about the prior claim and prior notification. So if there has been a prior claim or a notification on a previous policy, then that policy should be the one to respond. And you probably no doubt be aware that those kind of disputes are generally the subject of disputes between insurers for coverage points. And just as a quirky example I could give you in respect of a matter that I was involved with is where there was a costs order made against an insured law firm by a court. There was a dispute as to whether that was defined as a claim under the policy because it was not notified for some time. It went to an arbitration and the arbitrator found that a costs order against an insured was a claim under the policy because it's compensatory in nature, so it does fall within that definition. So I'm just going to move on now to the future because Angus has already discussed where we were and where we are now. So where could we be? So once cover has been confirmed by the insurers, even if the premium has not been paid by the insured, then cover is still in place. The same goes for any run-off premium not paid, which of course can be quite costly for insurers because they are potentially facing claims for 6 years following the closure of a law firm. On a similar point, if the excess is not paid by the insured in 30 days for a claim settlement payment, then that claimant has the right to seek payment from insurers. So in those circumstances, an insurer faces a challenge as to whether they should be pursuing and essentially suing their own insured for that money or whether they should simply swallow the cost. Problems arise obviously for law firms that have closed down in the run-off period because their ability to pay such excesses is going to be very weak. So insurers basically face liability to be paying out 100% of all claims made in 6 years after the closure of the firm. I've just set out there that the International Underwriting Association actually wrote to the SRA last month in September for cover to be cancelled if any payments are not made by insureds in respect of excesses and premiums. And as far as I'm aware, there hasn't been a response to that yet. So I'm afraid all I can say is let's just wait and see what happens with that. Just in terms of the future, which we've considered, there could be some scope for insurers to enforce stricter payment terms. on their insureds for both premiums and excesses. There could be an increase of claims to the SRA compensation fund, particularly in respect of if there's any changes made to the run-off cover. That itself would be costly to the profession, but having more clearer and stricter payment terms may be beneficial to insurers, because they would have more clarity that they are going to get paid for the service and insurance they are providing. So I'm just going to hand back over now again to Angus.
Thanks, Daniela. I mentioned a mutual at the start, and what I did mean to add to that was that just as a matter of interest, that mutual is still going 20 years on after closing its doors to new business. And that just emphasises the long tail nature of these types of policies. So is the MTC fit for purpose? As I mentioned earlier, I've always used to think it was, as far from the law firm's perspective, but my view's slightly changing on that as things develop. For insurers, I definitely don't think it is fit for purpose. I think it is too wide and too uncertain and too long-tailed in nature. Recently, the market has hardened due to claims experience over the last 10 years or so, other exposures that insurers have faced, and also, as I say, the nature of the policy, and in particular the sideways nature of the policy, by which I mean that any law firm can have as many claims as they like, up to £3 million per claim in any given year. They may not be trading the next year, but the insurer on risk would have to meet all of those claims. But in particular, the risk of carrying 6 years of run-off cover is particularly prohibitive. As a result of all of that, there's been significant premium increases over the last 2 years in particular, whether or not law firms have actually got a good risk record or not. That's resulted in some law firms being able to obtain quotes, or the quotes they have got have been financially crippling. These two last points have made me reconsider really whether or not the current policy terms are actually fit for purpose and best for the profession. I'll suggest that if there does continue to be a hard market, in some ways that's good for insurers, then we may see events of 2000 repeat themselves, with pressure for change being placed on the SRA by the profession itself. And it's that route that I think that we're going to see the biggest chance of change to the policy terms for insurers. We may also see an amended MTC that's better fit for purpose for all for the next decade. The concern being that I think the larger law firms might start to find that their premium increases are as a result of the policy conditions, and therefore they themselves may voice or lobby for change. I'd like to go on to a few golden rules before we go to the Q&A session. A little bit like Kirsty and Phil in location, location, location. It's important to investigate, investigate, and investigate again when claims and notifications hit your desks. The extent of the notification is really important to try and narrow down as and when it hits the desk. Recommendations, don't just accept it and note it, look at it and perhaps question whether or not it is indeed a valid notification. And if it is a valid notification, what it is aimed at covering. Also, it's important to consider early notifications for the points Daniela made earlier around whether or not it would fall to a previous policy year. As always, the claim date would put it back in the previous year as well, but it's important to investigate whether or not there has been a claim in a previous year, because sometimes it really isn't obvious. So if a letter of claim comes in, that may not be the first time that there's been a grumble. It may not be the first time there's been a complaint, but unless you or we dig a bit deeper and get all relevant information from the law firm concerned, we're not going to be able to determine whether or not a prior claim was made. Successive practice issues come into play, of course, and again, that is a topic of itself, but it is the main point there being your insured may not be the successor practice to the firm that's being sued. Aggregation, always one to consider it when there's a case of multiple claims arising from one transaction. As we mentioned, dishonesty. Dishonesty can be expensive to deal with, and consideration should always be given as to what the end outcome is likely to be. But there are plenty of examples that we've had where we've had significant recoveries made from the dishonest partner concerned, but all commercial considerations need to be put into play. I'll now pass over to my colleague, hopefully, Harriet Strevens in our London office, who may have a couple of questions.
Thank you very much indeed, Angus. We do have a couple, but we're running a bit tight at the moment, so I'll limit it to one or two, if I may. One of the questions that's been posted is, do you have a view on why the SRA have balked in particular at the idea of limiting runoff to only 3 years?
Well, effectively, at the end of the day, they didn't accept any of the proposals and weren't prepared to change anything. I can double check how, but the SRA actually were for it. There's a political debate between the Law Society who were against it. And so the Law Society were the ones that weren't happy with the idea of a shortened runoff period. The driver for that being public protection, and also the unknown cost of extending a 3-year period to 6 years.
And so I suppose your answer to the question, why do you think, or what do you think is stopping change in relation to policy terms and conditions, also relates to that public policy point?
It doesn't, and the public policy point has existed pre-2000. It's always been around the public having confidence that they will not lose out in the event that the profession acts effectively negligently, and that's sort of been what's sat behind the minimum terms and conditions not changing substantially.
Thank you, Angus. We do have a few left, but we'll deal with those if we can by way of email after this session. Back to you, Angus.
Okay, thank you. Well, thanks for joining us today. I hope that was useful. Please do complete the feedback form at the end when we sign off, and let us know any future topics you'd like us to discuss. Just so you're aware, our next 15-minute webinar will be on Thursday, the 22nd of October at 11 AM, when James Thompson will be speaking about consumer insurance. So for now, have a good day.